Welcome, everyone. Thanks for joining us on Market Mondays Weekly Insight on a Tuesday. Hope everyone had a very good long weekend and happy Diwali to everyone who celebrates. My name is Tilan Vikramasinghe. I'm the head of research for Maybank in Singapore. If you haven't had a chance to download our weekly newsletter, you can do that by scanning the QR code on your screen now. Now, we've got a very busy week coming up with a lot of data releases and some very important meetings. And we've also had some big gyrations in the market, particularly this month, and I'm calling the November markets Jekyll and Hyde sort of markets. You know, we've got markets getting all excited, thinking that the rate hiking cycle is starting to come to an end, and at the same time, we have the market starting bearish, going bearish when they think that the Fed might be getting a little bit more hawkish. So in times like this, it's always important to have a lot more defensiveness in your portfolio, but also keeping an eye out for alpha opportunities. So that's what we're going to talk about today in our show. We're going to talk about first the elephant in the room, the US and China, and the very important meeting between President Biden and Xi Jinping happening on Wednesday. And we've got Erica who will talk us through what her expectations are for the Chinese economy. We've also got a couple of alpha opportunities, one in the internet sector and another one in the food and beverage sector, and also a couple of defensive opportunities, one in gaming and also in industrial. So please do stay with us through the show. Now, let's start with market moves as we usually do. Last week, as I said, the US was quite cautious. We didn't see much movement in the S&P. It was down about 0.1%. But we did see a little bit more activity and action in North Asia. We saw the Hong Kong and China both up, the HSI up about 1.3%, China's composite up about 0.2%, partly, I think, with expectations of normalizing relations with the US, but also some stimulus expectations as well. Southeast Asia was a little bit more mixed. We saw the STI down about 0.9, KLCI down about 0.5%. And then the set was a little bit higher. Give me 1 second here. Now, one of the interesting things that I found was that we saw Bitcoin going past 35,000 again. So I think there's a little bit more risk coming back into the market as well. Now, kicking things a gear, as I said, we got this big meeting this week between President Biden and Xi Jinping of China on the sidelines of the APAC Economic Cooperation Summit in the US. There are some expectations of normalizing relations, or at least as far as that can go. And we did see some, big announcements here, some potential Boeing deals, an agreement on things like drug control and so on with China. Now, what does that all mean? So I've got Erica, our China expert, on the show today. So welcome to the show, Erica. Let me kick off. You wrote a big report, and you highlighted that capital outflows from China in the third quarter has turned negative for the first time in 3.5 years. Now, let's start there. So, what's driving this? And is this just investment outflows, or or is it much broader?
Hi, Tilan. Indeed, China has had the first net capital outflows actually in 7 years. If we exclude that blip in COVID, which was 3.5 years ago. And there are three drivers behind these capital outflows that make us believe that this pattern might continue even into next year. So this has implications for the RMB exchange rate and how the government controls the flow of capital in and out of China. So the three drivers behind this episode of capital outflows was not really trade related, in the sense that China was still exporting more goods than it was importing. So goods trade wise, it was still registering the customary surplus. But what we saw was two very interesting things, right? One was that even though China was having a current account surplus, which means it was exporting in general more goods and services than it was importing, actually it saw a large capital account deficit, which means that in terms of investment flows, there was a net outflow that overwhelmed the trade part of the equation. So what's happening was, number one, Chinese travel demand has been making up about 90% of its services trade deficit. And that has kind of pulled back during COVID, but we expect that that's slowly recovering, and the Chinese tourism flows are still far from normal, right? So we think that when Chinese tourism goes back into full swing next year, and that's when the Boeing aeroplanes will become handy as well. That will lead to a huge weight on China's current account. So that's the current account. And then in terms of the capital account, two very curious things are happening. Number one is foreign direct investments are turning negative for the first time ever. So what this means is that foreign investors are actually pulling back on their planned expansions in mainland China. Now, if viewers follow our macro work, you will know that we have been covering this topic of more FDI flowing into ASEAN markets in a bid to diversify from China. So right now we're seeing these trends bearing out in the data itself. So this is set to continue next year. And the third trend is really portfolio investment outflows. So previously, 10 years ago, very few people were investing in equities and bonds in and out of China. But since then, the connectivity has opened up. So we expect that net portfolio investment flows will continue to be quite unpredictable. And in some quarters, it might still turn back to negatives. So these three drivers in total make us believe that next year, capital flows can still be negative in some quarters.
Right. Thanks, Erica. So that's something we need to watch out for. But obviously, there's some positives there for ASEAN, with especially with tourism, as well as some of those capital coming into this region as well. Now, when you take all this into account, Erica, how are you thinking about the yuan going into 2024?
So what happened in the last quarter was quite interesting. So even though the market's attention was fully focused on the yuan depreciating against the dollar, but in actual fact, what very few people talk about was that the yuan was appreciating against its trade-weighted basket of 24 currencies because primarily the US dollar was appreciating against every other currency. So we expect that in the coming year, the PBOC would employ a three-pronged approach towards capital flows, right? So number one, depreciate the RMB against its trade-weighted basket. And then this is in line with actually our FX team's view that the yuan will appreciate against the US dollar. Number two, the PBOC is likely to selectively intervene in the FX market to prevent overly volatile movements in the yuan. And number three, we believe that the central bank will scrutinize capital outflows, especially those of its residents, more carefully.
Great. And very quickly, Erica, just in terms of how you're thinking about economic growth for China, especially on the back of these meetings and things like that, are there any silver linings going into 2024?
So I think one thing that we hope will come out of the Xi-Biden meeting is that there can be a cooling down of pressures on the trade side. So we noticed that China's trade is still in contraction, despite strong US growth. So we hope that the cooling off of some of these tensions will help to raise China's export growth. That said, at the moment, we think that China's GDP growth is still having underlying momentum that's not as firm as we hope. So a lot of the growth is still being propped up by policy support, including central bank easing and fiscal easing. So I think going forward, policy support is still the energy and the force that's driving GDP growth.
Great. Thanks, Erica, for joining us today. Now let's turn to some stock ideas, and I want to highlight a note from Jarek, who's banging the table on Food Empire. This has been one of our key Opportunity Plus stocks this year, and as you know, Food Empire sells instant coffee mixes, largely in the CIS countries like Russia, as well as some of the Southeast Asian countries like Vietnam as well. Now, despite the depreciation of the ruble, third quarter earnings came out to be very, very solid. They actually have managed to pass through some of those cost increases, and also we've seen Vietnam growing quite strongly as well. So he thinks that on the margin side as well as on the volume side, we should continue to see expansion for Food Empire as we go into 2024, and for 2023 in particular, that should result in a record year in terms of net profits. 2022 was a record year. 2023 is going to break that record. That's what he's expecting. Now, with those sorts of numbers, the expectations are for a better dividend than 2022, and according to his forecast, we are looking for a yield close to 5% for 2023. And also, there is expectation that management will continue to do share buybacks and support the share price as well. The stocks flatlined a little bit over the past 1 month or so, so this could be a good buying opportunity. We've raised our target price to 160 Sing dollars, which is almost a 50% upside from here. So do have a look at Food Empire. Now, another alpha opportunity, in my view, is the internet stocks, and particularly Grab. We have Kelvin on the line. Can we have the Grab price chart running, please, Lyndon? Great. So not a great price chart, especially since the interest rate hikes happened. But Kelvin is written a note talking about the strong beat in third quarter earnings, and on the back of that, Kelvin, you've actually raised your profit forecast by around 8 to 10%. So what's driving this confidence for you?
Hi, Dylan. Thanks for having me. So I think as many of the fast growth internet companies in the region, Grab has previously relied on unsustainable customer subsidies to gain their market share rapidly. However, we know that this era is expected to be over, and as interest rates surge and possibly normalizing at a much higher rate, in order to achieve break even this quarter, I think Grab has been very prudent with its investment while creating a unique and affordable ecosystem. So if we got to peel the onion to look at each individual segment, so if we look at the delivery segment, we see that there is meaningful reducing incentives level. So Grab is also, continuously adjusting its algorithm to improve drivers' efficiencies. So we note that, recently Grab introduced affordable pricing meals and tiered pricing for food deliveries. So as incentives, grow these are the incentives to grow their total addressable market. So we with this incentive, we feel that, deliveries will reach a margin of 3.4%, and with revenue growing 79% year on year and 5% quarter on quarter. So Grab is, getting both gross margin improvement, but with reducing incentive at the same time. So we believe that, this further, grow Grab's order intensity and thereby improving, unit economics. Um, Grab's dominance in, Southeast Asia ride-hailing market also give its logistical edge over its arch rival GoTo. Is positioning well for outsized traffic growth as social restriction fall away. Um, Grab also introduced the Grab Unlimited, which is a paid subscription plan granting perks, including delivery discount to customers. So I think it's comforting to see that the user subscribes to Grab Unlimited has average retention rates that are 2 times higher than non-subscribers over the first half of 2023. And Grab also continue towards improving affordability for its consumers while increasing order batching to raise efficiencies. So I think beyond demand recovery, we believe that the ride-hailing platform has been focused on solving the driver supply shortage issue, which has been a bottleneck, especially in Singapore and Philippines. And coupled with the region's largest e-wallet, their fintech in Singtel GXS Bank. So they have the wider suite of online financial service offerings. So I think Grab could sustain strong sales growth beyond 2023 and beyond break even. Grab will continue to sharpen its focus on its adjusted EBITDA and free cash flows while maintaining cost discipline to drive further operating leverages. So we also see a promising growth outlook for Grab with its unique ecosystem synergies and continuous drive for balance in growth and profitability. So we would reiterate buy for Grab at raise target price of 450 from 420. Yeah, thank you.
Thanks, Kevin. So operating metrics are starting to improve, and that's going to, drive some interest on the stock. And I think, especially as the outlook for interest rates starts to stabilize, this may be a key stock that investors start to relook at. Kelvin, very quickly though, I know ST Engineering's results came out as well. Now that's very different from the internet stocks, very defensive. And those numbers are quite strong as well. Any sort of very quick comments on ST Engineering at this stage?
Okay, so we think that the recovery in airline capacity should underpin demand for regular aircraft maintenance in the commercial aerospace segment. So it's complementing passenger to freight conversion and multi-year projects, especially. And hangar capacity expansion is on the way with a fourth hangar in Guangzhou in the second half of next year, 2 hangars in Pensacola for FY25, FY26, and 1 each in Ezhou. And the Changi Creek that's up and coming in FY25 in Singapore. So I think the execution of the USS segment of 500 million New York congestion pricing project in the second half as well will streamline SATCOM and ease supply chain pressures should lead to a 50 million in cash savings and an additional 30 million in EBIT in FY24. Having surpassed pre-pandemic revenue levels, we think that the commercial aerospace as well. But we need to know extremely cautious with the downside risk of global economic outlook is uncertain with the ongoing Hamas-Israel war, and the recovery of the airline segment has been sporadic as well. But will remain our target price and recommendation as buy.
Great. Thanks, Kelvin. I have an audience question here asking about some of the stocks to play on a Chinese tourism rebound. So that actually comes nicely into the third sort of alpha idea that defensive idea that I want to talk about, which is Genting Singapore. This was a late post that came in from analyst Samuel. He's traveling at the moment, but it was a very bullish set of numbers. We saw that Genting's third quarter numbers beat expectations, and VIP volumes actually surged to an 8-year high. And we also saw that mass market revenues have also increased. A lot of this is actually happening without having full Chinese inbound tourism support. So I think as we start to see more Chinese inbound tourism, which has been one of their key markets, there should be more upside potential there. The group management has also announced the RWS 2.0 strategy, which will play out and get completed by about 2031, which is slightly later than what was originally planned, which in around 2029. But part of that is just premiumization, trying to attract much more premium customers into their ecosystem. We've actually raised our target price there to $1.16, and we're maintaining buy, which is a 41% upside. Another stock to look at on the tourism rebound would be some of the retail REITs like CICT, and also Dairy Farm, which should also benefit from more inbound tourism. Now, there's a few more questions. I'll try to take a couple as quickly as possible. We got a question here. The market is pricing US rate cut for May, April. What might change this, and what to look out for in tonight's US CPI readings? So US inflation, if you look at overall consensus, is looking for a slowdown to about 3.3% in October versus around 3.7% last month. So if we do see any sort of upside surprise to that, particularly on the core inflation reading, this might trigger more bearishness, particularly as the Fed might turn a little bit more hawkish if core inflation remains quite stubborn. So that's something to watch out for. Our own in-house views is that overall interest rates will probably not see a cut as early as May, April, but more towards the second half of the year and more towards the end of the year. So we are still looking at higher for longer sort of interest rates. So second and the final question, can we expect a Santa Claus rally this year? And if yes, how best to take advantage of it? So statistically, from a quant point of view, there is typically on a normalized year around 70% sort of chance of a Santa Claus rally in month of December. So that's something to watch out for. We're already starting to see some ingredients of that with expectations of rate stabilization, overall inflation coming off, and so on. I think some of the key sectors to look at would be the more interest rate sensitive names, more growth oriented names. So the internet stocks, the consumer stocks would probably be some of the key beneficiaries of such a rally. But also, I think another sector to look at, particularly as there would be more expectations of interest rates it'll probably solidify more expectations of interest rate cuts going through, would be the REIT sector as well, the S-REIT sector in Singapore. The valuations are quite cheap. The results generally this year has been mixed, but are improving, so that there might be some opportunities there as well. I just want to highlight a key event coming out on the 22nd of November. We actually have AIMS APAC REIT management who will be presenting, so do join us for that presentation, and maybe that might give you some ideas on how the REIT sector will perform going into December. Unfortunately, we've run out of time for today, so thank you very much for joining us, and please do join us next week and have a profitable trading week. Thank you.